my father-in-law's course in psychology, and I thought I might go to law school. I knew there were a whole bunch of subjects I wanted to read about. And then I sort of stumbled into this partnership a few months later because 7 members of the family said, we want you to handle our investments. And I didn't want to do it one at a time or tell them what I was doing. So I put the 7 together in a partnership that had $105,100 in it. You can guess who the $100 was.
Yes, I know.
and I thought that was it. And a few months later, a fellow named Homer Dodge, who had been a stockholder at Graham Newman, came out, saw me in Omaha, and he said Graham Newman was liquidating, and he said he'd asked Ben where to put his money, and Ben said maybe Warren would be a good choice. So he joined me for, I think, about $100,000 at the time. And then 4 months later, some fellow in Omaha that read the legal notice, actually, a friend of mine called me up, said, what are you doing? And I told him, and he did it. So yeah, I just kind of stumbled along.
You kind of stumble along. Yeah. All of a sudden you have a partnership,
right,
and you're making money.
And I couldn't sell Keo now, understand? But the partnership did well, and part of the partnership was buying what looked like cheap stocks. Berkshire Hathaway looked like a cheap stock. It was a terrible business.
Now, Buffett didn't start his career with grand ambitions, but his early reluctance to manage investments highlights a mistake many investors make: underestimating the power of value investing and early decision-making. In this next clip, he explains how he stumbled into managing money for others, showcasing the critical role of patience in navigating an overvalued market.
What was your ambition then? Now you have a vehicle.
Yeah. Well, I started out by thinking I was a textile expert, but I was disabused of that notion fairly fast. I really did. I thought, what do these guys know about making textiles? They've only been doing it a few hundred years. I mean, the Egyptians, I think, figured out how to weave.
But I've been in Omaha for a while.
That's right.
I know a lot about textiles.
Just turn me loose at the plant and see what happens. So anyway, what happened was right at that period, the textile business was good for a very short period of time. And so I was like a duck floating on a pond when it was raining. I was going up in the world, but I thought it was because I was flapping my wings, but it was that damn rain that was coming down. And then when it quit raining, I mean, I found out, what do I know? Right. Yeah. And then we went into other businesses.
Yeah.
One of Buffett's early missteps was thinking he could master an industry without experience. This belief led to his investment in Berkshire Hathaway, a textile business he later admits was a mistake. Here, Buffett reflects on how thinking you're an expert in a market that seems to be thriving can be a huge mistake.
What are you thinking? I mean, I'm just going to continue finding investments that I can make, and everything will turn out all right.
In the mid-'60s, I was running this partnership, so I thought I was going to keep running the partnership. And then I got to where I didn't think I could do that well. And
why did you think that?
Well, the market in 1969.
Oh, the stock market.
The stock market just went crazy, and it was a little like, in 1999 and 2000. I mean, I was left behind, and I didn't want to do things I didn't understand and that didn't make sense to me, but I also didn't like sitting there while everybody else was, running rings around me, and my partners were probably not saying it, but they might think, has this guy lost it? So I gave them all the money back, and I gave them the shares of Berkshire, and got a lot of them myself as part of that. And then I just kind of got more involved in Berkshire. It became my painting. I was only painting an hour or two a day at the start, and then I started painting like crazy.
So you had a stake in Berkshire.
Right, and I actually bought more, but I just decided I'd put all my money in Berkshire and ride with it.
And ride with Berkshire as a vehicle, as
a kind of an extension, a corporate extension of me.
Buffett discusses the inflated stock market of the 1960s, comparing it to the dot-com bubble in 1999 and 2000. When markets become overheated, many investors chase returns. In this clip, Buffett reveals the emotional challenge of staying disciplined while others are making fast gains, something every investor faces in an overvalued market.
In 1973, would maybe your first run at the Washington Post, you began to buy shares.
Yeah.
How did you come to the conclusion?
I'd looked at the prospectus in 1971 when Charlie and I first met Kay Graham one time, and they were going public right at the time of the Pentagon Papers. And then in 1973, the stock got very cheap because their television licenses were under challenge by B.B. Rebozo, Nixon's friend, and the stock went from, I think, like 38 to 16 or so in a very short period of time. And when it got down to around 20, just in a few blocks, we bought almost 10% of the company, and that now is about 18% because they've repurchased shares. When it got to about 20, that meant the whole Washington Post company, it had 4,800,000 shares. The whole Washington Post company was selling for $100 million. Now they owned the Washington Post, they owned Newsweek, they owned 4 big network television stations, including CBS in Washington, D.C. and all of that.
Jacksonville, Florida.
I mean, everything, and they didn't owe any money. And if you had taken those separate parts, you literally could have been out in the middle of the Atlantic Ocean, at midnight in a rowboat, and you could have sold them for $500 million. People would have been swimming out in shark-infested waters if necessary.
And you could have had all of it for $100 million at that
for
time.
$100 million. I mean, you weren't going to get all of it because
Here's what I don't understand. How come 95 people didn't see that?
It was amazing. We were buying it from big institutional investors, and they were bailing out of it. And if you'd asked any one of them what the pieces were worth, they would have said something close to what I would say. But they thought the stock was going to go down. So what? And the stock did go down.
Here, Buffett talks about his investment in the Washington Post during the time of market panic. Most investors overlook the intrinsic value of the business because of short-term fears, a common mistake in overvalued markets. His ability to focus on long-term value instead of price fluctuations was a big thing. Watch as he explains his reasoning behind this iconic investment.
In 1988, you started buying Coca-Cola. How come?
I don't remember exactly. Probably read their annual report. Probably read the 1987 annual report. I've watched it some, but there just comes a point, there's a tipping point, in terms of knowledge you've accumulated over a period of time, price changes in the stock, which had gone down some. They were heavy repurchasers of their own stock. Roberto and Don were doing a terrific job. Nothing bad was going to happen to Coca-Cola, so I started buying. Most of it in that period from the middle of 88 to early 89, but then a little further on. But we put overall about $1 billion into it, and it's probably worth about $8 billion now.
And you have no intent to sell?
No.
Buffett reveals how he invested in Coca-Cola at a bargain price during the late 1980s, and has held on to it ever since. Even though he acknowledges it got overvalued during the dot-com bubble, here he reflects on his decision to avoid selling, showing how long-term thinking can triumph over short-term speculation.
You have said, though, that during the bubble,
it got overpriced.
There were some things that you might have sold,
sure,
and would have been wise to have sold them at that time.
If I was running the partnership like I did back in the 60s, I definitely should have sold those stocks. I mean, stocks went crazy.
But you do not today look back and say, I should have sold Coca-Cola when the bubble was there, because
it wasn't me. I mean, I wouldn't, I knew it was selling at a very fancy price, and I even wrote about it, and same way with Gillette. But I don't do that very often. I'm not saying I wouldn't ever do it. I mean, if we went into the wildest speculative orgy in history, and some of these things went crazy, maybe I would sell some. But it's not it goes against the grain. For one thing, wonderful businesses are not that common. And if you get a big position in a wonderful business, not a bad thing.
In this next clip, Buffett addresses the temptation to sell during speculative bubbles. While he admits that certain overvalued stocks could have been sold, his strategy is clear. Wonderful businesses should be held even when the market is soaring. This approach underscores a mistake many investors make: selling too early in an undervalued market.
With more than $40 billion essentially in cash,
right,
you could buy some big businesses, I would assume, for $40 billion.
Right.
But you don't see any at a price that you want to own.
That's right. And when I look at the deals that have been made in the last year, there's not one I'm envious of. So, I mean, it isn't like we missed them. It may turn out that I should have bought one of them, but I mean, there's none that I feel, gee, I wish I'd bought that last year.
Buffett, sitting on $40 billion in cash, turns down the idea of chasing overvalued businesses just to make a deal. Many investors get impatient during market highs, but Buffett explains why waiting for the right price is crucial.
But General Motors, and listen, I think they're doing a great job considering the hand they're dealt, but General Motors is a huge annuity and health insurance company with a major auto company attached. And unfortunately, the huge annuity and health company has got a terrible bunch of contracts out. I mean, it is worth some big minus number. And the question is whether the auto company is worth a big enough plus number to offset that big minus number, but you can't separate the two.
In this segment, Buffett breaks down General Motors' situation, overwhelmed by legacy costs, which made it unattractive even at a seemingly cheap valuation. He explains how the failure to understand the full picture of the company's financial health can lead to grave mistakes in the overvalued market.
You don't have any single candidate right now.
That's true. That's why you see these tears in my eyes.
It is. I mean, tell me the emotional feeling. I mean,
I
don't mean tears, but there is a certain sense of.
It's happened before. I mean, I closed up my partnership in '69 because I didn't feel there were any opportunities then in what I was doing, managing money, and there weren't. I mean, at least for me. And in the year in 1999 and 2000, in the general stock market, there was certainly nothing attractive, and we found some businesses then. But it happens from time to time. I mean, I am not in a business where you can do something smart every day. I'm not even in a business where you can do something smart every year, but I may be in a business where you can do something smart every 3 or 4 years.
Buffett admits he's not trying to make smart moves every day or even every year. Patience is key. And as he emphasizes here, it's a mistake to feel pressured to make a move during overvalued markets, instead of waiting for a truly good opportunity.
I mean, do you ever say, man, what am I doing here? My commitment to the end is.
No, looking back, I made a mistake by not selling.
You could have sold it at the time, 3 or 4 years ago, right?
Or something. Yeah, but no, I don't look back on things. Yeah.
Okay, but let me just stay with that idea.
Yeah.
So you look back and you say, when it was $80 a share, I should have sold it because that was at its top, say, or close to its top, and
50 plus times earnings.
Right.
Yeah.
50 times earnings. But it's not in your blood to want to sell.
No, but I do sell marketable securities sometimes.
Okay,
I don't sell businesses.
Right.
But I do sell marketable
sure, and this
securities.
is a marketable security.
That was a marketable security.
As is American Express, as is.
Yeah, but I don't sell See's Candy or the Buffalo News.
Oh, sure.
Yeah, I don't sell businesses.
Buffett acknowledges that while he occasionally sells marketable securities, he avoids selling long-term holdings like Coca-Cola even if they're overvalued. This reluctance to sell exemplifies his belief in the mistake of panic selling just because the market is overheated.
Since I last talked to you, you have, with the consent, in concert with other members of the board, have chosen the successor?
Well, what we have, Charlie, is we have 3 that could do it. And every meeting of the board, we don't have very many meetings, but every meeting of the board, that's the subject. And the question is, if something happens to me that night, who do they put in charge? So they always go away knowing what they would do the next day. Now, there may be a pool of 3, but we have settled on 1 at any time. And so if something happened to me tonight, tomorrow morning, the board of directors of Berkshire would convene, and they would know exactly who they were going to put in charge.
You will run Berkshire as long as?
As long as I keep my marbles.
As you'll see in the next section, Buffett stresses the importance of always having a clear successor ready to take over. Especially in an overvalued market, having a solid leadership plan helps avoid emotional decision-making, a mistake that can lead to disaster for investors.
Is the insurance business still as attractive to you today as it was from the beginning?
It's always been a business that sort of fits me. I mean, it gives you the money first, so the investment element is important. It also is a business where you're calculating odds on things, and
that's what you.
I guess I was probably destined to be a bookmaker, but my dad wouldn't let me.
You can calculate odds, but I mean, in the insurance business, is the increasing number of hurricanes, the increasing number of the terrorism is a fact of life today.
I think so.
No matter how you can write a policy against all those things, I mean, does it make it any less? Is it?
Well, you have to get the right. You have to calculate the odds right. You got to get the right premium, and you never know whether you've gotten the right premium. I mean, over a lifetime whether overall you've gotten the right premium for things, but you lose on some policies, and on other policies nothing happens, and so you don't know in any given day or week or month whether you're doing the right thing. But over time, you'll see whether your judgment has generally been right.
Next, Buffett discusses the insurance business model and how it fits perfectly with his investment style. In this clip, he highlights why underestimating risk calculation is a common pitfall in overvalued markets. It's a warning to investors not to overlook long-term risk when chasing short-term gains.
Do you worry about inflation?
I worry some about inflation, sure. Inflation is never gone; it's always in remission, and you know it's very easy.
Never dead, but always.
It's never dead, and it's something that is man-made and governments can create, and it oftentimes seems preferable to some alternative that's in the here and now. So you have to worry about, anytime you have governments, you have to worry about inflation.
As you'll hear in this segment, inflation is never far from Buffett's mind. Ignoring the creeping threat of inflation is one of the key mistakes investors make in booming markets. And here Buffett explains why it's something to always keep an eye on, even when things seem stable.
When you think about the dollar,
I think the dollar over time will go down because I think we're following policies that, in connection with trade, that will cause the dollar. I don't know whether it'll be in 6 months, 6 years, 10 years, but the policies we're following as a country will cause the dollar, in my view, to decline.
Primarily our trade deficit.
Our trade deficit, right? And the flip side of our trade deficit is when we consume more than we produce, we have to trade the rest of the world something for that, and we give them our assets. We give them IOUs of the government. We give them dollars initially, and then they can convert those into other assets in this country. So we are trading away assets in order to overconsume.
As you said to me earlier, we're giving away pieces of the farm.
Yeah, we'll give away pieces of the farm. We want to consume more than we produce, and so we trade away a little bit of the farm. And we've got such a big farm. I mean, it's this is one prosperous country, but we can trade away. We don't see it day by day, but it adds up, and it has consequences.
In the next clip, Buffett predicts a decline in the US dollar due to trade policies, a red flag for investors in an overvalued market. If you're not thinking about how currency devaluation can erode your returns, you might be making one of the biggest errors in overestimating the current market conditions.
Do you accept the argument that countries like China are locked into this dance with us?
As you'll see in the upcoming section, Buffett offers a calm response to fears over global trade imbalances. He cautions against making hasty decisions, a mistake many investors make during market highs, where fear of a crash can lead to poor timing and missed opportunities.
I've always been happy in the world, but I've never been happier. I've got the most interesting, to me, job in the world. I've got people you wouldn't believe that support me. It takes about 4 or 5. I mean, it takes a village to a degree, but I've got 3 people sitting right down within 20 feet of me, or 30 feet. My assistant, Deb Bosonic, the fellow that handles all the trades I tell him to do in the morning, and money and billions flow in and out, and he takes care of it all. Mark Millard, and I've got a chief financial officer, Mark Hamburg, who knows more than most of the finance offices and legal offices and everything else in the world. And we've all worked together for dozens of years.
Buffett kicks things off by emphasizing one key mistake investors often make: working with the wrong people. As he highlights in this clip, having a strong, trusted team is essential in navigating complex markets, especially when valuations are inflated.
Just week after week after week after week.
You made your first investment when you were 11 years old?
In 1942, 80 years ago, I took $114.75, every penny I'd saved, and I bought 3 shares of City Service Preferred. And City Service was a pretty well-known name now and then. In fact, in 1920, City Service, I think, was the 4th largest company in the United States in terms of number of shareholders. It was a big company, and so it had a preferred stock that was selling at 38 that had started skipping the dividends during the Depression. So it accumulated dividends on it of $60 or $70. And of course, it was par value of $100 too, and it was selling at 38. And breakfast one morning. I follow all the stocks every day, but then I made my plunge, and I had roughly this amount of money, so I bought 3. I don't remember this precisely, but I think I told my dad in the morning, "Now, let's move, Dad." Pop, I call it. But let's move, Pop.
But you felt the thrill of it then.
Oh, I've been reading about it and following it. The whole market. I really had read every book in the Omaha Public Library that was on the stock market.
By 11?
By 11, I'll guarantee you. And some of them twice. I started out reading the ones in my dad's office, and I just loved to read. I mean, I read other things too, but I knew more when I was 11 than I know now. I mean, in terms of actual mechanics of the stock.
Next, Buffett shares a crucial lesson about his early investments. Here, he reflects on how many investors, especially in overvalued markets, get caught up in short-term stock prices instead of focusing on the long-term value of the business.
But when I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. I read Garfield, Drew, I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. And I rejiggered my mind when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded. But I became an owner of a business. And I did not care whether a stock went up or down the next day or the next week or the next month or the next year.
In this next section, Buffett points out a classic investor error, trying to predict stock movements. As you'll see, he explains why it's far better to think like a business owner than to obsess over whether a stock will go up or down next week.
Orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
Pardon me?
And what do you think about?
I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it because I'll buy more.
Do you have a competitive spirit? Clearly.
Yeah.
Clearly.
Well, but you got to be careful about what you compete in. It's a good thing I don't have a competitive spirit in chess or or football or anything like that. No, I'm an observer there. I enjoy watching things like that, but I try to keep my competitive spirit in a game where I can win.
Next, Buffett reveals one of the most common mistakes investors make, focusing on price movements instead of the company's intrinsic value. He explains why this short-term mindset leads to emotional decisions, which can be especially dangerous in overvalued markets.
I would have to honestly say that what makes me happiest is what I'm doing. I enjoy two things about it. One, I know I'll win over time. That doesn't mean I'll beat everybody else or anything like that, but I'm in a game that's very, very, very easy if you have the right lessons in your mind about what you're buying. I'm not buying stocks. I'm buying pieces of overwhelmingly American business. And I'm happy when that's when I'm doing it. I'm happy when stocks are going down. I'm happier when stocks are going down because I can buy more of them with the same amount of money. I'd be happy if I was a farmer. I'd want farmland to go down. So I could buy more.
As you'll see in the next part, Buffett explains why he actually prefers when stock prices drop. As he describes in this clip, many investors panic when prices fall, But for him, it's an opportunity to buy more of a good business at a lower price, a lesson many forget in a booming market.
I'll tell you the second thing I really like. I like being trusted by people. And, I would rather do what I do with partners than do it sitting in a room myself, even though I might make more money that way.
You like the idea that people are trusting you with their savings.
Yeah. They just say, look, I've saved money, I don't know what to do with it. And
I trust you.
And they give it to me. And they don't, most of them give it to me, certainly in the original days, but even now to an unusual degree. Give it to me with the idea that
Next, Buffett highlights why being trusted by others is such a powerful motivator for him. However, he notes that many investors chase short-term gains instead of building long-term trust, especially when the market prices are sky high.
Just think if I had a 35-minute commute. I've gone to the same office now since January of '62. So it's been 60 years, and let's say I save 30 minutes every day in commute, each way.
Let me turn to the stockholders' letter that you wrote for 2021.
Well, that letter was, I started that letter in my head. I've already started next year's letter in my head, but I started that letter in my head, we'll say.
Because you can begin to see what 2022...
I know what I'm going to write about it, and then I just have to, it keeps forming. But that isn't a newsletter that comes on.
Next up, Buffett explains how long-term thinking and patience with investments have shaped his career. Listen closely as he talks about writing shareholder letters in his head and why long-term planning is crucial in markets that seem overvalued.
Because you didn't see anything that met your requirement.
Yeah, and I wrote the report, and people can go to BerkshireHathaway.com and they can see exactly what I think and have thought for 40-some years of each report.
But for you to make a big investment, what do you need to know?
I need to know that I think that Berkshire Hathaway is going to be worth more money someday down the road. Not tomorrow. I want it to go down if I'm buying something. And I would say this, the world has changed a lot since that report was written. But the world changed a lot in 2000, 2 years ago when the pandemic. Just think about it.
Because of the pandemic.
The pandemic.
As you'll see in the next clip, Buffett reveals a fundamental mistake investors often make, rushing into investments without considering future potential. He emphasizes why, even in an overvalued market, he needs to see a clear path to future gains before making any major moves.
Day by day report. The book just came out a couple days ago.
We expect the Fed will raise the rates. Does it remind you of 1970s?
Everything that happens in the investment world reminds me of something or other. Every day. If it's a boring day, it reminds me of something. But I don't think that way. All I'm trying to do is buy businesses. Let's pretend there is no stock market. Let's say I had to buy these privately, like you buy a farm privately, like you buy an apartment house privately. They're investments.
In this next part, Buffett urges investors to look beyond stock market noise and focus on buying businesses like their private assets. He explains why ignoring short-term market fluctuations helps avoid overpaying during times of market hype.
And then 4 other people you can read it all. It's filed with the SEC. And then after it was announced, you could buy the stock at $78 a share. So the implication, the first story was that it was that somehow that somebody made a great deal by getting tipped it off or something damn thing.
Simply
You
not
could
true.
have bought $1 a share. You could have bought after it was announced higher than one of the other fellows paid for about. He bought about 15.
Listen closely as Buffett addresses a major misconception about insider tips and market timing. He breaks down how even reputable sources can get facts wrong, and how this leads to poor decision-making in inflated markets.
Close to 15 million shares. He still got it.
Buffett echoes a powerful lesson in this next section. Opportunities to make great investments are rare, but in an overvalued market, The key is waiting for the right moment to act. Timing matters less than readiness when the market offers a truly good deal.
I think you may have heard this. Lenin once said, there are decades when nothing happens, and then there are weeks when decades happen.
That's very well put. And when you're buying businesses, don't call them stocks. When you're buying businesses, when you're buying apartment houses, sometimes when you're buying raw land, all kinds of things. There's times when you get a chance to act and do something really intelligent. May happen once every 10 years, once every 20 years.
Next, Buffett reflects on historical crises, like the pandemic, and how unforeseen events can disrupt even the most overvalued markets. He advises investors to stay flexible, because even the best laid plans can be overturned by global shocks.
A world like the pandemic.
That's true too.
And it can change everything, as it did.
It happened in 1929.
Buffett starts by discussing the resilience of the U.S. economy in this next part. But here's the key point. As markets thrive and wealth accumulates, investors often overlook the early warning signs of instability. In this clip, he touches on how external factors like rising mortgage rates could disrupt the current economic balance. It's a classic setup for overconfidence.
Things were in 1907. When they closed the stock exchange back in 1914 for a long period of time, people don't ever think about that. 9/11, they closed the stock exchange for a few days. And there are big events in this world.
We're going through one of them right now.
Yeah, but I won't get into discussing that particularly.
Allow me this. This is having a huge effect on the
It's true, but
world order.
Yeah, but it doesn't do me any good, and it doesn't do the world any good for me to talk about it. So,
Can we talk about the global economy then? In terms of
well,
where we are.
I can tell you where we are, but
Yeah.
but
Let me phrase it this way in terms of the global economy. You look at the United States.
the United States economy, and it's very easy to look at the statistics on it. More people, a greater percentage of the American population is wealthy now, or having more income now than they've ever had. And if you look at whether Bank of America will give you their average deposit, you just look at the wealth that's out there, and that doesn't mean everybody's wealthy, but it does mean relative to any other period of time. People have more money now. They get mortgages at lower rates than they've ever gotten. So if they want to buy a house or something,
But is that going to continue? Mortgage rates are raising, as you know.
Next, Buffett highlights an essential perspective. Living standards in the U.S. have improved significantly, even for those in the lower income brackets. But here's where many investors misjudge, believing that past growth guarantees future success, overlooking the reality that markets evolve and profits can dwindle.
where the bottom 2% in terms of income in the United States, the bottom 5%, and for sure the top 1%, all live better than John D. Rockefeller was living when I was 6 years old. John D. Rockefeller was the richest man in the world. And today, you can get better medicine, better education, better entertainment, better transportation. You can do everything better than he could. You can, it's astounding. That's in my lifetime. That if you wanted to watch a football game, he still had to go there. and I can sit there with this big screen, and they keep showing me the replay, so that and explaining to me what happened and everything. And maybe everybody doesn't have a screen as big as mine, but damn near everybody has a screen or an iPhone or a computer or access to one, and they have access. When I was born, the dentist didn't use Novocaine. When I went
So there has been progress, obviously.
in medicine.
And nowhere more than in the United States.
Well, relative to the base, maybe more than, but there's no country that's done what our country's done. If you go back 3 of my lifetimes, you're looking, you've been to Colonial.
You're 91, so.
It's 3 lifetimes. You are looking at less than 1% of the world's population, closer to half of 1%. Half of 1% of the people in the world are sitting in this land. They don't work harder than people in all the rest of the world. In terms of hours of unpleasant labor, everybody's got hours of unpleasant labor in those days practically. They don't come laden with gold and, they are half of 1%. And they work the same hours, they got the same IQs. They may be a little self-selected in terms of enterprise, in terms of going across oceans and things. And fast forward a couple of lifetimes, and they've got 20% plus.
Buffett paints a picture of America's economic power and innovation over 3 generations in this next section, but notice his subtle caution. Many investors make the mistake of thinking a prosperous history means an invincible future. Failing to recognize changing market conditions and thinking, this time it's different, can lead to poor decisions.
The Constitutional Congress, in 1789, if you go to any one of the representatives there, and you said, I want to tell you what this place is going to look like, in 3 more of your lifetimes. Your great-great-grandchildren, are going to be flying in the skies. They're going to be watching sports all over the world. They're going to be entertained. Their medicine. They'd have held you off to a lunatic society.
But at the same time, as you know, and you hear this all the time, 845 billionaires in America.
Yeah.
And they have more wealth than the bottom 60%.
That's true. And that's up to the government. The government has a proper place in the capitalism, believe me. And government's the rule maker. But Henry Ford, by 1922 or 3, he was turning out 2 million cars a year. Now, how many could the Ford family use? 30, 40, I don't know. So 2 million people are getting the benefit of what he's doing. And he's getting 30,000, he's getting 50 cars, and he's getting a whole bunch of little claim checks. Just think of it. Everything, when Thomas Edison did all the things he did, he made some money. But look what we benefit. We're using it.
Yeah.
It belongs to us, and it doesn't. If you take what an hour of labor delivered to you 100 years ago, and what an hour of labor delivers to you now for you and your family.
As Buffett discusses Tesla's rise in this next clip, here's another important lesson. While chasing the next big thing may seem tempting, many investors make the mistake of assuming market value always reflects long-term stability. Overvalued stocks often lure people at the wrong time.
It's unbelievable.
But that's an argument for the forward progress
That's an argument
of civilization.
It's an argument
and for
capitalism, but it doesn't. Capitalism doesn't say get rid of a referee and a government. We've got a government that can tell capitalism what to do.
Do you think?
And they do, and that's what they should do. And they do it in different ways at different times and all kinds of things. But I've got this money which I'll never. I can't. But it has value to somebody. It's claim checks on future output. That was it. And the claim checks belong to me. So if I want to buy 50 super yachts, I can do it. But what does it mean to me? It can buy more things for other people that are useful to them. And I have everything I want in life, everything. So it's not evil But the federal government is the boss in the end. And they shouldn't screw up capitalism, and capitalism shouldn't screw up the federal government. It's very simple.
But does capitalism need to be reformed itself? As you know,
it's evolving, always. We started in 1789. We had business, and it's gotten far, 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 unbelievably more productive for people. And the only thing it can do with what it produces is give it to other people. It isn't like the 50 richest guys in the country can say, I'm just going to eat everything. They're turning out products, that iPhone that I have, which I'm probably the least capable guy in the world of working with it, but it makes life better.
it is the reason that Apple is the richest company in the world.
Yeah, and you've had Tim Cook on before, and you can hear as a company that a guy invents something, and all kinds of other smart people do the same thing. Apple, I think, sells less than 25% of the smartphones in the world. I know a guy that produces as many as Apple does. But Apple has produced the one that's the most useful to people. It's an aspirational product. Somebody, a lot of people have made cars, but you got a few survivors that made the ones that people like the best. And, we would be selling 16 or 17 million cars a year in this country if we had 50 producers, or whether we got 3. We never used to have.
But here is an interesting fact, as you know. Tesla has more market value than all the other automobile companies combined.
Yeah, Elon Musk.
What does that say?
That shows what America produces.
Elon Musk?
Elon didn't, he's taking on General Motors and Ford and Toyota and all these people who've got all this stuff, and he's got an idea. And he's winning.
Now, Buffett has seen it all: wars, depressions, and pandemics. Yet many investors forget that turmoil always returns. As he mentions in the next part, the uncertainty of nuclear war or other major global crises looms. Assuming the markets will continue to rise unchecked, no matter the risks, is just something wrong to assume.
Well, I've seen 91 years of it. I've never seen a period where I didn't believe that. And I haven't read
that it will get better.
Of course.
In every aspect of it.
Not every aspect. We can go backwards in some. No, it's not. But it's unbelievable what has happened. Just think of it. We've had a civil war. We've had a Great Depression. We've had all these things.
Pandemics.
We've had. And we'll continue to. We'll have. I'll guarantee you, we'll have something. Next year and the year after and the year after. But in a herky-jerky but dramatic matter, business moves forward, government moves forward. More important, people move forward.
The thing that you fear the most, and you have said this, is nuclear war.
Yep. I think it was Einstein, maybe it was Bertrand Russell, this one, but he says this changes everything in the world except the way men think.
You don't want to talk about the current situation where one of the questions is, what if we end up with a World War III and a nuclear catastrophe? Is the reason you don't want to talk to me about it because you don't want to be quoted and people...
I don't want to talk about it, but I've talked about nuclear catastrophes in the past, and the truth is that, it was Einstein that said, I know not what the weapons of World War III will be, but World War IV will be fought with sticks and stones. And that says it all. We've got the power, and other people have the power, to essentially destroy the planet. And climate change is important in all of those.
In this next segment, Buffett reflects on the wisdom that comes with age, contrasting it with the decline in his mental sharpness. He emphasizes the importance of adaptability and seizing opportunities in investing, which can lead to mistakes when markets are overvalued.
There's all kinds of things we should be working on. But in the end, the only thing tomorrow. I mean, I guess a comet could hit us or something, but we can destroy that. And it's not just us. We can end the planet. And I don't want to talk about much more beyond that. I don't like saying that to people even, but it's true. It was true when Einstein said it. I mean, it's been true. You know, we came close to the Cuban Missile Crisis.
And it is being talked about now.
I'll let you talk about it.
No, I hear you. But let me, before we leave capitalism, in a sense, do you see any changes that businesses ought to do? Because, you know, there is, you know, on the part of Larry Fink and others.
There's always things going on. And
where does Warren Buffett come down on that argument?
I will be talking about a lot of things on April 30th at our annual meeting. And that's when I'm talking to all of our shareholders at the same time. And
the people who've trusted you to manage their money.
There'll be 40,000 in attendance, and it'll, it'll be taken around the world. And that's when I can talk to all, if they want to listen in, every one of my partners can hear at the same time on a Saturday. So the stock market's not open until Monday. And so they can digest it, or they can watch replays or anything else, because they can watch it on, CNBC will be sending it all over the world.
Watching is not like being there.
No, well, it isn't for a lot of people. But we're going to have, in my view, if it were held today, well, who knows.
Buffett shares insights into how his investing strategies have evolved as Berkshire Hathaway has grown, as you'll see in the next part. He highlights the challenge of finding meaningful investment opportunities in a larger context, a crucial lesson for investors navigating an overvalued market.
April 30th brings, but we will have, I think, from everything I hear, we're going to have the largest group come to law, I think, ever, and I sure hope so.
Do I hear you, and you can tell me I'm wrong here, that all those things that I might want to hear and your partners might want to hear and everybody wants to hear, A, because you're a student of history, B, because you have written about the evolution of history in annual letters as well as in answering questions at annual meetings. But on the questions of war and peace, and questions of New World Order, on the questions of sanctions, on the questions of inflation, all those things that I'm enormously curious about, you're holding back talking to them until you choose the venue that you want to be.
And there may be there may be a lot of things I don't feel I should talk about at that time too, but that is going to be a very, very important meeting. And I get that time to take all these people who trusted me with their money, trust me with their future, and I talk to them at the same time. And they can ask questions that they can be impertinent. They can do anything they want with us, and I love it, and Charlie loves it.
But you understand my curiosity.
Oh, of course.
But do I understand this is an important moment? This is a moment to speak to, and we're in a crucial time.
Yeah, but we've been in lots of crucial times. We were in a crucial. At 9/11. Did we think we were in a crucial time?
Sure.
The world changed in 5. And I didn't know how it had changed. The President of the United States didn't know how it changed. Nobody knew what the hell was going to happen.
I want to know how Warren has changed from decade to decade to decade. Do you have a sense of that?
I've gotten dumber, but I've gotten wiser.
Okay, that's a nice phrase. But what does it mean?
It means that I can't add a group of numbers remotely as fast as I used to be able to. I can't remember sometimes when I walk upstairs, while I'm walking up the stairs, I'm thinking about something else. So by the time I get to the top of the stairs, I don't remember why the hell I walked up the stairs. It means I forget names so easily. It means that I can't read as fast as I used to read.
Next, Buffett candidly discusses a past venture into healthcare with major industry players, illustrating how the brightest minds can struggle with complex problems. This serves as a reminder of the pitfalls investors face when chasing grand ambitions in inflated markets.
I am a decaying machine that still feels wonderful, but I can't hear as well, I can't see as well, my balance is as good, but it doesn't interfere with my happiness, my work, anything.
Especially your work. Well, I mean, clearly your happiness, but it doesn't, you're
It
saying,
doesn't interfere with
notwithstanding
anything. It doesn't interfere with anything.
that ages.
I can get on a plane, go anyplace. I can do anything as long as you don't ask me to dance. Or juggle, or even remember, who did I meet yesterday?
But in terms of doing the job that you do, allocating capital.
I can actually do that as well as ever.
As ever.
Yeah, that sounds obvious.
But better than that, do you do it today better than you did it 20 years ago?
Yeah, I've got a different set of opportunities.
And that gives you obviously,
well,
Berkshire is much bigger than it's ever been, and therefore that defines the choices.
The size restricts the kind of things that can have an important effect on what I can do for the people who leave the money with me. So I can't earn the returns on capital with 500, billion or 600, whatever it may be to work with. Like, if I do something brilliant, don't count on it, with $5 billion, it's 1% of my net worth. I mean, 1% of the net worth of the people I'm working with. And 1% doesn't move much, so.
In the next part, Warren Buffett critiques the American healthcare system while emphasizing the need for accessible medical care. His analysis reflects a common investor mistake, overlooking fundamental issues in sectors that may appear promising during overheated market conditions.
I have to think about big things, and they're limited. I mean, I made money in an entirely different way when I was working with originally $10,000, $9,800 to be exact. And when I started working with other people's money, it was $105,000. And May 5th of 1956, I had $105,100 put into that partnership. And Berkshire's the outgrowth of that. I went to the house that I was renting it for $175 a month the other day. I just come back from New York, and there's a little room. I would say it's about 5 feet by 8 feet, and I'd written on the door because I knew the people that owned it earlier. This is where it all started, May 5th, 1956. And I worked out of that little room for 2 years and moved to the house. And then I got another little room. I worked there for 4 years. And everything I did could double our net worth. That doesn't mean that I could find them all the time. But I mean, there were thousands of possibilities, and I wanted to know every one of them.
And there are not thousands of possibilities now.
Can't possibly be. No, there aren't thousands of possibilities.
Not many whales out there.
Not enough, but there's some.
Is that a moment of great exultation when you realize that's a whale?
Sure.
I see something.
Yeah, well, I mean, if you're looking for whales for months, you got to get some kind of thrill out of it when you find one.
Let me talk about something that didn't work. You and Jamie Dimon and Jeff Bezos came together. Healthcare is a huge part of our economy.
Yep.
And here we saw 3 really smart people representing 3 enormous institutions.
We had all the money in the world.
All the money in the world.
And we trusted each other.
Yes.
Totally.
In this next section, Buffett emphasizes the long-term value of index investing, cautioning against temptation to diversify too broadly. His thoughts serve as a critical reminder to investors about the risks of straying from sound principles in overinflated market scenarios.
And
which was well justified. So I mean, we had as good a combination as you could have in terms of resources, flexibility, mutual interests, everything.
And what was the intent?
The intent was, well, we had several intents, but I mean, we had an intent and we had a hope, and we knew the hope was nothing. I mean, we didn't know whether it was 50 to 1 against it or 100 to 1 against it, but what was the downside?
The problem was so big it was worth trying.
Yeah, and what was the downside to us? Nothing.
Right.
Zero. Maybe we looked like we couldn't solve it, which is true, but that's okay.
Why couldn't you solve it?
Oh, it's three. You know, it's as big as federal government receipts. I mean, it employs more people, and it's not a terrible system. I mean, it's so much better than it was 20 years ago and 50 years ago and 100 years ago. So, I mean, we've got a wonderful medical system.
But we're fighting over it all the time.
Well,
I mean,
anytime you get a big pie in this country, people fight over it.
But I mean, as you know, until Obama did what he did, you know.
Yeah, well, I think
Clinton failed, and then Obama.
No, I think what Obama did was good. I think it was a real important progress for the American people. And then the question is how to make it better.
And to make it better, what we need to do is A, bring the price down, and B, make the accessibility to it.
You've got to be sure everyone, a rich, unbelievably rich country
Like America.
can be sure that every single person not only has access, but feels he or she has access, that knows that he can get reasonably prompt. I mean, there comes limits with pandemics and everything, but reasonably prompt and if necessary, and essentially free. I mean, it isn't free in the sense that society doesn't pay for it, but the ability to get good medical attention reasonably fast, should exist for every American.
But it
It's that
doesn't.
simple.
It doesn't.
We do pretty damn well, but we could do better.
But we're not.
In this next part, Buffett discusses the importance of trust and character in business relationships, which extends to investing. Understanding who to trust in an overvalued market is essential, as making the wrong choices can lead to significant losses.
And what's happened, of course, is that organizations like to grow. So they set up indexes on different industries, different countries. And as soon as you do that, you're violating basically what Jack Bogle said. He says you don't know enough to pick the right businesses, which means you don't know enough to pick the right countries, you know enough.
All right, let me get to that. And that's something I want to get to. But we will see a time in which the Chinese economy is bigger than the U.S. economy.
Someday, they got 4 times as many people, and logically, they will grow and grow, and we're the 2 superpowers.
Are they going to grow as fast as they have been growing?
It's hard to tell. No, I don't know the answer to that.
But they've got some issues. They've got issues.
Sure.
They've got issues of.
Yeah. No, I just.
They've got issues of debt. They've got issues of.
Everybody's got issues.
Demographics.
Yeah, everybody's got issues.
You know, those kind of issues.
Everybody's got issues.
They've got also issues.
We've had issues throughout the history of the United States.
They've also have issues of the environment and climate. The UN just released a report, and we have heard it, and we constantly hear it. How worried are you about our success in protecting the planet?
Well, the biggest threat, obviously, is nuclear weapons, but it doesn't mean you don't protect against other things. And if there's a 1% chance, even, and it's way high, I can't quantify it, but if there's a 1% chance of something causing the world trouble, 10 years from now, 50 years from now, 100 years from now, we ought to be working on that too.
Are we doing enough?
We're doing a lot. The problem is, of course, that It requires the whole world to do a lot.
There are a lot of problems like that, including the pandemic, including the environment,
Sure.
that transcend national boundaries
Yeah.
and need
Yeah. Yeah.
cooperation.
The virus doesn't have to clear your immigration.
Oh, it does.
Buffett reflects on his relationship with Jeff Bezos in the following section, highlighting the importance of collaboration and learning from others. This underscores the idea that investors must remain open to insights from different sources to navigate the challenges of overvalued markets effectively.
The virus does not have to clear immigration.
No, that's simple.
It can be brought
And
in
there's a
by
lot
one
of other
person.
things. There's a lot of other things that aren't physical viruses.
When you look at Tim Cook,
I think he's terrific. It's that simple. I've written the annual report,
yes,
and he is.
he was a great manager.
He's not only great manager, he's a great human being, but he's a great manager too. He's an incredibly great manager, but he's a great human being.
What do we look for in a great manager?
You look for him. You look for somebody that has
Results.
You look for somebody that has ability, trust, and character.
Ability, trust, character.
Yeah, somebody you can trust. Same thing you want in a spouse. Charlie always says you want to marry somebody better than you are. He says in my case that leaves the whole world practically. But it's the truth. I mean, you always want to be around people who are better than you are. They pull you in the right direction.
What's the chemistry? What's the nature of the relationship between you and Charlie? It's a long, long relationship.
We met in May of 1959. His father died. He had worked in the same grocery store as I had in 1940. I worked there in 41. And we never met. I didn't know his name. And his dad was, well known and all on, but I just didn't happen to know. I was a kid and we moved to Washington. And so it was a name
Your dad went to Congress.
I never heard his name until I was 1959. Or no, I heard the name when I met the day. It was maybe 57 or 58. He came to Omaha in 1959. We met. And it's been, the best relationship except others I've had, in family and so on. But it's been, he's been the person, along with Tom Murphy and a fellow named Joe Rosenfield, subsequent to my dad, that I didn't want to disappoint. Good to have somebody in your life you don't want to disappoint. It's enormously important. Makes you a better person.
Do you disagree on a lot of things, or?
Well, we've never argued. We've never had an argument. People say, well, that's impossible. I'm telling you, we've never had an argument. Yeah.
We've handpicked a new video that we think is going to be super valuable in your journey, building true wealth. It's right here on your screen, so click to watch it too. Don't forget to give this video a like and subscribe to our channel if you haven't yet, and I'll see you in the next video.